Bismillahirrahmanirrahim. In the second video on accrual accounting, we build on the concepts covered in the previous video. We revisit the revenue recognition principle and the expense recognition principle, emphasizing their importance in accurate financial reporting. We also delve into the necessity of adjusting entries and provide guidance on recording adjustments for accruals, including accrued revenues and accrued expenses. Furthermore, we discuss the adjusted trial balance, which includes all adjusting entries and serves to validate the accuracy of financial statements. Finally, we demonstrate the process of preparing an income statement and balance sheet after adjusting entries have been incorporated, ensuring the completeness and correctness of the financial reports. Please like, subscribe, and share my channel to search for accounting lessons and hit the notification bell button to alert you for the latest video. For all of your questions, comments, and suggestions, please put them in the comment section below. And for webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Accounting is AK. We hope that this video helps students in their academic development and teachers in enhancing their lesson plans and teaching methodologies. Accrued revenues are earnings that have been earned but not yet recorded by the statement date. In the previous video, we have talked about generalizing and posting and post adjusting entries about on deferrals. In this video, we are going to talk about generalizing and posting and adjusting entries for accruals. Accruals can arise from accumulated interest or services provided but not yet billed or collected. To rectify this adjustment, entries are made to acknowledge the receivable at the balance sheet date and the revenue earned during the period. Before adjustment, both assets and the revenue are undervalued. We are going to use the same trial balance that we have used while discussing the first part of adjusting entries, that is deferrals. So the adjusting entries for accrued revenues increases the assets account, we debit it, and the revenue account, we credit it, ensuring accurate reporting of both assets and revenues. So Sara Corporation in October performed guide services for $200 that were not billed to clients before October 31st. So Sarah's corporation's accounts receivable indicates that the client owe them 200 as of the balance sheet. The service revenue balance will be, I would like to show you the trial balance. Now here we have 10,000 for the service revenue. If you can recall, the company has earned 400 in the case of deferrals, when they have earned service revenue for $400. This was with reference to the deferrals, and now they are they have provided they have performed services for $200 and these have not been billed. So actually the total revenue will be 10,000 plus 400 plus 200 for the unearned service revenue earned in the case of deferrals, and 200 that they have earned now. Now without the adjusting entry, the balance sheet and stockholder equity understates, while the income statement understates revenue and net income by 200. Now, if on November 10, Sarah receives 200 cash for the services performed, then obviously cash will be debit and accounts receivable will be credit. This has been explained in this table. You can see that uh, the accounts receivable increases by 200 and the service revenue increases stockholder equity by 200. Increase in asset is debit, increase in revenue is credit. We have a accounts receivable for 200 and the balance is 200. For service revenue, we have 10,000 in the trial balance, 400 for the unearned service revenue earned in the deferrals. You can refer this for in the previous video. And now there is a service revenue credit of 200. So accrued revenues, they are accrued because of interest or rent or services. So the reason of for adjustment is services are performed but not yet received in cash or we have not recorded them. So assets are understated and revenues are understated. So we have to increase the assets. Increase in asset is debit. We have to increase the revenue. Increase in revenue is credit. Okay. Now, accrued expenses are costs that a company has incurred but hasn't paid or recorded by the statement date. Examples include interest, taxes, and salaries. To account for these expenses accurately, adjustments are made to recognize the obligations existing at the balance sheet date and to reflect expenses for the current accounting period. Before adjustment, both liabilities and expenses are understated, so the adjusting entry for accrued expenses increases the debit and expense account and increases credits the liability account. This adjustment ensures accurate reporting of both liabilities and expenses. Let us look into an example. Now, Sarah Corporation has a 5,000 note outstanding on October 1, outstanding with 3 months until maturity. The total interest due will be 5,000 times 12 and for because we are going to have for 1 month of October, so that is equal to $50. So this calculation is applied to determine the interest for the month of October and the journal entry will be interest expense debit and interest payable credit. You can see that expenses have increased and so have the liabilities. This has been illustrated here as well. Uh, our liability increase for the interest that we have not paid and this will decrease our stockholder equity. So interest expense is debit and interest payable is credit. Okay. Now Sarah Corporation pays certain expenses like employee salaries and commissions after the service has been provided. For instance, Cyrus paid salaries on October 26 for the first 2 weeks of work, with the next payment scheduled for November 9. In October, 3 working days remain 1, 2, and 3. So the expenses, as you can see over here, is 400 per day, and for 3 days 400 times 3, that will be equal to 1200. So we have not paid the salary, so our liabilities are increasing and our stockholder is decreasing because of salaries and wages expense. Our salaries and wages expense are going to increase and that is debit. There is an increase in liability as well and that is credit. Now you can see that in the trial balance, the for the salaries and wages expense, Uh, Salaries and wages expense are for 4,000. So we have a balance of 4,000. Now salaries and wages expense are debit by 1,200 and our liability increased by 1,200 as well. So accrued expenses, the examples are again there may be accrued expenses for interest or rent or salaries. Expense has been incurred but not yet paid in cash or recorded. So expenses are understated and liabilities are understated. So we have to increase our expenses. Expenses are debit. We have to increase our liabilities. For liabilities are going to be credit. For these are going to be the adjusting entry for accrued expenses. This is the summary of of adjusting entries for the we have prepaid expenses and unearned revenues, and these are accrued expenses and accrued revenue. These are accruals and these are deferrals. In the case of prepaid expense, assets are overstated, expenses are understated. So expense is going to be debit and assets is going to be credit. In case of depreciation, there will be a contra asset, that is accumulated depreciation. For the unearned revenues, liabilities are overstated, revenues are understated. So liabilities has to be decreased because they are overstated. So liabilities are debit and revenues are credit to adjust the account. For accrued revenues and accrued expenses, we have already explained just now. So let us move on to the next slide. So once adjusting entries for Sarah Corporation on 31st are done, so these entries are going to be, these are the general entries that are going to be recorded, and you can see these are for the both accruals and deferrals. Uh, and these entries are recorded again into the ledger as well to reflect the company's financial position. The adjustment and process involves identifying and rectifying discrepancies in accounts to align them with the revenues and expense recognition principle. You can see there is no effect on the cash or common stock or retained earning or dividend, but there is an increase in accounts receivable, there is an increase, there is a change in the balance for supplies or for the service revenue. So wherever there is a change, they have been highlighted with a red color. And after making these adjustment entries, the ledgers are going to be updated to reflect the changes. The balances are, you can see they have been highlighted in red to indicate adjustments made during the period. So in summary, we can say that adjustment entries and ledger postings on 31st October are vital for Syra Corporation to present reliable financial information and comply with accounting standards. Now, after adjusting entries are made, companies prepare an adjusted trial balance which lists all account balances at the end of the accounting period, including adjusted ones. The purpose of the adjusted trial balance is to verify that total debit balances equal total credit balances in the ledger after the adjustments. It is the main tool for ensuring accurate financial statements because it contains all necessary data for reporting. So, after adjusting entries are generalized and posted, a company creates an adjusted trial balance which lists all account balances after the adjustments. Its main purpose is to ensure that total debits equal total credits after the adjustment. That is important. The adjusted trial balance contains all the essential data for preparing accurate financial statements, and you can see that those wherever there are adjustments they have been highlighted in red color, and you can see after the adjustment the total of debit is equal to the total of credit. Okay. So the adjusted trial balance serves as the foundation for directly preparing the financial statements. From this trial balance, the income statement is built using revenue and expense accounts. The retained earnings statement relies on data from the retained earning account, dividends accounts, and net income or loss derived from the income statement. Next, the balance sheet is crafted using assets, liabilities, and stockholders' equity account. The balance of the retained earnings reported on the balance sheet originates from the ending balance in the retained earnings statement. This approach ensures the accuracy of financial data portrayed in the company's statement. So here you can see that we have the adjusted trial balance, and from this we take all the expenses and revenues, and we get the income statement, and then on the basis of this we prepare the retained earning statement, where the beginning retained earning is 0. The net income is coming from the income statement. We subtract the dividend of 500, and we have the ending retained earning of 2360. Now this is going to be transferred to the balance sheet, and in the balance sheet we record all the assets and all the liabilities and the stockholders equity from the adjusted trial balance, and you can see that all the assets and liabilities have been recorded. You can see that for the depreciation we have the contra entry accumulated depreciation equipment. This is subtracted, and this is the book value for equipment, and in the end you can see that the total of assets is equal to the total of liabilities. So this completes the second video on accrual accounting. I hope you have enjoyed this presentation, and if you found value in this video, then please like, subscribe, and share my channel, and hit the notification bell button to alert you for the latest video. For webinar and guest speaker invites, please send me a message at accountingamir@gmail.com. Remember, effective questioning brings insight, which fuels curiosity, which cultivates wisdom. If you have any question or any suggestion regarding this session, then please put them in the comment box below or by email, and inshallah I will reply you back. Thank you so much and happy learning.